One of the basic rules of money management is to always have a stop loss whenever you enter a trade. Stop loss is an order that you set ahead that tells the platform to automatically close your position if it gets to a certain level that is against your prediction. The market can be unexpected at times, and this is your way to protect yourself for not risking more than you wish. If the platform you use does not support automated stop loss orders, you need to do it manually. Set a mental stop, which is a level where you decide that you'll get out of a losing trade if the negative scenario happens. When time goes and with price changes, a smart thing to do is to adjust your stop loss level. However, it is important that you do it only with the direction of the trade. You do it in order to protect temporary profits or to make sure that you don't lose anything in this particular trade. So if, for instance, you bought some currency and it goes up, you either keep the stop at the same level or raise it higher. You should never lower it because this is the point where traders allow themselves bigger and bigger losses. If the trade didn't work out, that's perfectly fine, and probably there is a good reason for that. You should simply get out with a small loss and start over. Again, don't play with stop levels in losing positions. When you do that, it's the first sign for ruining your account. There are two main considerations as to where to place your stops. The first one is technical. You look at the chart and look for a good location. If you buy, you better put your stop below a recent support level. It doesn't necessarily need to be a support line. It can be an indicator, a strong candle, or any significant level. When you sell, you do the same thing, only instead of placing it below a support line, you put it above a resistance line. The logic here is that you know that in the support area there is a buying power that is likely to push prices higher, but there is also the chance that the support will be broken and a down movement would initiate. So when you put your stop below the support, you lower the chances to be stopped out of your position. You know that the only case in which your stop level is triggered would be if the market signals a reverse in its direction. And in such a case, you don't want to be in with a position to the wrong side anyway. Look for example here. We have these two lines, one functioned as support and the other as resistance. Within this range, we have opportunities to buy or to sell whenever the price is getting closer to one of the extreme levels and place a stop level accordingly. So if the price goes down toward the support, we could buy and set the stop loss around here. If on the other end it was climbing all the way to its resistance area, then we could enter the market with a sell order and locate the stop slightly above this line. Remember that you don't want to place the stop too close, because then the price can easily touch it and go up again, making you losing the trade. You don't want to put it too far either, because in such case it's less likely to be triggered, but when it does, it would cause a large loss. So this type of stop loss point makes sense, both for your money management rules and to your technical analysis strategies. So the second thing you need to consider is the risk management rules we just spoke about. You want to make sure that if the price triggers the stop order, then the overall loss wouldn't be higher than the percentage you are willing to risk. So basically, you are looking for a strategic place on the chart which will also match your capital risk rule. And if it doesn't, you better skip this trade and look for a better opportunity. If you have to choose between them, go with the percentage rule and not the technical stop. Remember that protecting your capital is always the first priority. When price goes in your direction, and assuming it have not reached your profits target yet, you want to look for a good opportunity to adjust your stop and raise it to your original entry point. By placing your stop there, you ensure that even if the price will reverse, in the worst case it will get to the break-even point where you don't lose anything. However, you don't want to do it too early. You want to give the trade some flexibility and not to completely limit the range it can move within. Now, there are no exact rules as to when you should do it, as it depends on the currency, the market conditions, and the specific strategies that you use. But with the time, you'll see that you feel the asset you trade on and therefore naturally know where are good levels you can make such adjustments. One thing you can do is to look for the average daily range of the coin and wait until the price reaches at least 30% of it. There is a very nice tool you can use. It's called ATR, or Average True Range. You have it in TradingView and in most other platforms. We are not going to go over it now because this is currently not the main point and it's very easy to use it. You simply add it to your chart exactly as you do with other indicators, and it presents the relevant data. This is just one idea you can use, but again, there are many considerations which are up to the specific situation. But the bottom line is that whether you use a tool like the ATR or any other one, it's never a bad idea to raise your stop and protect yourself. Of course, as long as on the other side you let it run for potential higher profits. In some cases the price will go down, touch your stop, get you out of the position and then jump back higher. You should not feel bad if that happens. Novice traders kick themselves for not letting the trade run, but they are wrong. If you put a stop loss, you did the right thing. Even if in this particular scenario it made you miss a nice movement and maybe some profits, you traded well. And this is more important than winning one trade, because over time it will always pay. Another thing about how you manage a trade that goes to your direction. You need to understand that your profit or loss of a current trade are not theoretical, even if they are still just on paper. You need to relate to them as if they are completely real and therefore risk only a portion of it. So if for instance you are now having a gain of $100 on paper, then you don't want to risk losing all of it. You want to make sure you protect at least some of it, while on the other side you let it proceed and grow your gain. If you are a conservative trader and your percentage rule is not to risk more than 2% of your account, you can simply move your stop in the direction of the trade and every time make sure that you don't risk more than 2% of your growing equity.